Okay, welcome everybody to our weekly Outlook webinar. This is Ilian Yotov. I am the founder of allthingsforex.com and tradertape.com and the host of the popular daily All Things Forex daily broadcast. You're welcome to attend the program and listen to the broadcast Monday through Friday at 8 a.m. to 9 a.m. Eastern Time, and then it's reprogrammed and rebroadcast for another 12 hours for the rest of the day. Before we continue, let me remind you that this webinar is intended for educational and informational purposes only, and it should not be considered as giving any buy, sell, or hold recommendations. And I'd like to thank our friends at fx3.com for putting together these series of webinars. What we're here today to discuss is the trading week, June the 6th to June 10th. Another busy trading week is ahead of us. And many of you have perhaps paid attention to how the market's attention, as we discussed a few weeks ago. During the webinar last Sunday, if you recall, I said the market's attention could easily shift into from the problems in the Eurozone and the Eurozone debt crisis back to the situation with the United States, paying attention to what is the condition of the economy, state of the U.S. economy. And we had a list of important spotlight economic events throughout the past week. And many of you perhaps have noticed how the market's attention quickly shifted from the Eurozone and putting significant pressure on the Euro and the Eurozone debt crisis concerns back to putting pressure on the U.S. dollar, especially after throughout last week we have seen rather disappointing economic reports from the United States, culminating with another very disappointing one, which was last Friday's non-farm payrolls report and employment situation report, which in my opinion was a daunting reminder of the lack of significant improvement in the U.S. jobs market. And obviously the other economic reports last week also showed us that the economy may be losing some momentum there as far as the recovery is concerned. So we saw that transpiring into, despite of the problems in the Eurozone, we saw how it transpired into U.S. dollar weakness. Now, going into next week, we don't have a whole lot of important economic data from the United States, with the exception of the jobless claims next Thursday and also the trade balance report for the U.S. Because of that, I think, because of the lack of the abundance of important economic data from the U.S., the market's attention next week could easily shift back onto what's going on with the Eurozone and other economies around the world. And we have some signs that things may be slowing down, but without a doubt, next week is going to be the week where the Euro, in my opinion, is going to take the center stage. And of course, because of the fact that we have the European Central Bank interest rate announcement, which is coming up on Thursday, next Thursday, but also because we have some other economic reports before that from the Eurozone, including the Producers' Price Index on Monday. We have the Eurozone Growth Domestic Product Report, which we'll discuss, that's coming up on Wednesday as well. And then there's, of course, other three major central banks besides the European Central Bank who are going to announce their interest rate decisions. So it's going to be the kind of a week where the market's attention will be on the monetary policies of major central banks. Now that we got a little bit of a hint or a clue, if you will, with the weakness in the non-farm payrolls report, with the weakness in other economic reports throughout the last several weeks, that the U.S. economy and economic recovery may be losing some of its upward momentum, that means the Federal Reserve will be in no hurry to actually start exiting their ultra-accommodative monetary policy. As a matter of fact, because of the weakness of this U.S. economic data, we are now, in my opinion, from now on, we're going to start hearing more and more of the speculation about QE number 3, the so-called quantitative easing number 3, asset purchase program that the Fed has announced. We had 1 and 2 already in play. QE number 2 is due to expire in June. But now there's more and more talk and increased speculation, if you will, that the Fed is going to have no other choice, but because of weakness in the U.S. economy and the lack of significant improvement in the U.S. jobs market, I would not be surprised for us to see the market speculating and pricing in some expectations that we might actually witness a QE number 3. So the very first spotlight event that I have chosen for next week for us is going to come from Australia and is going to bring us the Reserve Bank of Australia's interest rate announcement. Many of you probably remember that in the first quarter of 2011, in February, if I'm not mistaken, we had these massive floods in Queensland, in a Queensland area, with the capital there being Brisbane in Australia. And that took a toll on the Australian economy. It really hurt Australian exports and producers, and it's mainly an exporting economy, obviously, the economy of Australia. So it's very important for exports to do well. With the floods, economic activity was severely disrupted. And if you paid attention to the GDP numbers earlier this week from Australia, it was a rather disappointing report which showed the Australian economy actually contracting. As a matter of fact, it registered its largest contraction in the last 20 years in the first quarter of 2011. Now, this was all as a result of the massive floods in Queensland. But now the Reserve Bank of Australia officials and some government officials there in Australia as well have said that despite of that contraction in the first quarter, this has been a temporary event. And obviously, they're not concerned that this is going to be is going to persist in the quarters to come. So, if that is the kind of language that we also hear from the Reserve Bank of Australia, if the Reserve Bank of Australia, by the way, I don't think that a lot of people are expecting the Reserve Bank of Australia to make any changes to their existing monetary policy as far as hiking interest rates. More than likely, the consensus is that they're going to keep interest rates unchanged at 4.75%. But it's going to be important, the kind of a statement that comes out from the Reserve Bank of Australia next week. And if it is what some would consider more of a hawkish type of a statement, for example, the central bank acknowledging that the shrinking in the economy in the first quarter is a temporary event that passes. And on top of that, we've discussed for months now on this program that the Reserve Bank of Australia has been expressing concerns about rising commodity prices, which is obviously inflationary pressures, and also another type of inflationary pressures that are building up with wage increases. The increase in wages, which is also a cause of concern from, obviously, an inflationary event, and a concern for the Reserve Bank of Australia. So if the statement contains the type of an outlook that is a positive outlook on the economy and the economic activity, and also there is a warning and concern about rising inflationary pressures in Australia, then that could really help the market's expectations of possible future interest rate hikes that may come from the Reserve Bank of Australia. Although, again, it is widely expected that interest rates will stay unchanged at the current level, 4.75%, which is still gives the Australian dollar obviously very significant yield advantage, yield differential in favor of the Australian dollar over other lower yielding currencies, especially very low yielding currencies such as the US dollar or the Japanese yen for that matter. Both of these central banks, the Federal Reserve in the U.S. and the Bank of Japan, keeping interest rates at record low levels near 0%, and at 4.75%, it's not really difficult for you to see the huge yield advantage of the Australian dollar, which has been the darling of the so-called carry trade. But as of late, and we'll take a quick look now at the Australian dollar, US dollar daily chart. Now, let me switch us very quickly here to this screen. Let's go to the daily chart of the Aussie against the US dollar. So the Australian dollar is being the darling of the so-called carry trade. It's one of the preferred currencies to take advantage of these yield differentials compared with other lower yielding currencies. But as of late, now you would recall that we had the Australian dollar enjoying a nice little rally from pretty much the month of March all the way from 0.9704, which was the low there on March 17th, to as high as the new record high for the Aussie versus the US dollar, which was a little bit above $1.10. So we're talking about 1,300 pips of a gain in a very short period of time, so very significant gain. Now, when we saw a few weeks ago the Australian dollar starting to lose that upward momentum, we discussed the potential for a more significant price correction that the Australian dollar could go through. And that is exactly what we saw. And for several weeks now, the Australian dollar has fallen from a little bit above $1.10 to a little bit above $1.04 level, with an intraday low at $1.0440 here on May 25th. Now, on 1,300 pips, of course, what we did a few weeks ago, before that price correction for the Aussie started, we calculated at 1,300 pips, up to 50%, what a lot of traders would call the perfect 50% Fibonacci retracement, should more than likely bring the Australian dollar US dollar exchange rate down from around the $1.10 level by about 650 pips. That would be the perfect 50% retracement. Now, we have fallen about 600 pips, give or take, a little bit less than 600 pips. So we haven't really seen the Australian dollar reach exactly 50% retracement, but if the market has now decided that in the last couple of weeks that retracement may be over with, and we're starting to see the Australian dollar now beginning to break above these previous highs. Last week's high was $0.0756. Surprise, surprise, of course, that's an important price level in my quarters theory, being the large quarter point at the $0.0750. If that is what we continue to see, the Australian dollar attempting to break above this important large quarter point area, which is the $0.0750 area, I think that the Australian dollar could very easily, if, of course, the Reserve Bank of Australia is hawkish next week, if the Australian employment report, which is coming up on Wednesday, is a positive one, provided we don't have any negative surprises. And, of course, when we talk about higher yielding currencies, especially higher yielding commodity currencies, we always have to keep in mind these two factors, which are, of course, the risk appetite, investor sentiment, and commodity prices as well. If investor sentiment is positive, if we get to see strong risk appetite throughout next week, coupled with rising commodity prices, strength in equities markets, which normally would be supportive for investors' desire to take some additional risk, those are the kind of factors that we'll continue to watch. And if all of them come together to support the Australian dollar, we will watch the $0.0750 area and the high from Friday, which was $0.0774. That was, by the way, very close to a previous high. You could recall there was some resistance level right there on April 21st, which was at the $0.0773. So the high on Friday was not a coincidence, obviously. Both of these numbers a little bit above the large quarter point at the $0.0750, but previous resistance was established there. So if that area is taken out and the Aussie dollar pair breaks decisively above the large quarter point at the $0.0750 and above that resistance from Friday, and all of these factors that I just mentioned earlier were to come together, we could see the possible bullish for the Australian dollar scenario that takes the Aussie dollar pair working on that large quarter between $0.0750 and the major large quarter point at the $1.10. For those of you who are new to my quarters theory, in a nutshell, with the quarters theory, I propose that currency exchange rates and their fluctuations and price fluctuations in general in the markets are not random and are not chaotic, but they happen in a rather organized manner as prices fluctuate between these large quarter points of these 1,000 pip ranges. For example, the current 1,000 pip range for the dollar, for the Aussie dollar versus the US dollar is the 1,000 pip range between these two major whole numbers or major large quarter points, as I like to call them in my quarters theory. I will put the lines here for you. That is the parity level, the major large quarter point at $1, and then the major large quarter point at the $1.10. In terms of price interest points or pips, this is a range which is a constant range that never ever changes of exactly 10 cents, or in terms of pips, 1,000 pips. So with the quarters theory, I divide each 1,000 pip range into 4 equal parts, or 4 large quarters of 250 pips each. So each 1,000 pip range has 4 large quarter points of 250 pips, 4 large quarters of 250 pips each. So not a surprise there to see the Australian dollar actually now lingering, as we speak, around the large quarter point at the $0.0750. If we had to lay down the rest of the large quarter points, this is what your 1,000 pip range between $1 and $1.10 would look like. And you can see these patterns that the Aussie dollar pair has been actually producing here, fluctuating between, for the most part in the last several months, fluctuating within that 1,000 pip range between $1 and $1.10. So now the very final last quarter of 250 pips of this 1,000 pip range is, of course, the large quarter between $0.0750 and a major large quarter point at $1.10. That's why it's going to be important whether next week the Australian dollar will find the catalyst, which I think that it could possibly find that, again, if risk aversion is less, if there's more risk appetite next week, if commodity prices stay positive, strong, if we get to see a hawkish Reserve Bank of Australia statement, and if the employment report on Wednesday is not a disappointment, which I don't think it will be a disappointment, actually, and we'll talk about that in a few minutes. So that's a bullish scenario for the Aussie dollar. If that bullish scenario does not happen, then the opposite scenario would be the Australian dollar finding resistance somewhere in this area here, and then ultimately pulling back to previous lows, which could potentially establish a range within which the Aussie dollar pair could be trading. And it has been pretty much for the last several weeks. You can see that range between $0.05 to $0.0750, move back to $0.05, a little bit lower than that most recently, going back to $1.05, pulling back now back to $0.0750, or roughly the large quarter between $1.05, $0.0750 in the last several weeks has been serving as a range where the Aussie dollar exchange rate has been trading within. John is asking what will be the critical levels to watch for the Australian dollar. I would say the large quarter point at the $0.0750 and that resistance at the $0.0774, John, would be the critical price levels to watch. A decisive break above these levels could really open the door for the Aussie dollar pair to challenge once again the major large quarter point at the $1.10. Now before that $1.10 level, do not disregard the existence of the resistance level, which is here within the range of that large quarter. That resistance level would be $0.0888. So that is roughly a little bit ahead of the $1.09 level. So keep in mind that along the range of that quarter, you may have another resistance that the Australian dollar must overcome in order for that large quarter between $0.0750 to $1.10 to be successfully completed. Now let's go ahead and take a look at the rest of the certain spotlight economic events for us next week. Number 2 event for us, I've chosen to be the Eurozone Gross Domestic Product Report, the main measure of economic activity and growth, obviously, coming only one day ahead of the European Central Bank interest rate announcement. We have a question from one of our listeners. Shall we expect a week of new bear of Euro-U.S. dollar currency pair? I'm guessing that that's a question that he's probably trying to say, should it be a week where we get a bearish trend for the euro versus the U.S. dollar? Well, last week was a week where we saw a very much of a strengthening of the euro. And for obvious reasons, as I explained last Sunday, the attention shifted from the problems in the Eurozone to what's the situation with the U.S. economy. And when we found out what we were suspecting, that we might see weak economic data from the United States, when the majority of traders found that out, obviously that put some pressure on the U.S. dollar. We had some good news from Chinese support that they're going to be buyers of European sovereign debt. That happened a week before last week. Obviously, we discussed that turned out to alleviate some of the market's fears of the debt crisis, that these countries, the debt-ridden nations, will have problems refinancing their debt, that they will have problems finding buyers there. China really gave us an assurance a couple of weeks ago. That alleviated some of the market fears. That helped the euro, and along with that, the weakness in U.S. economic data was really kind of the catalyst as well for the market to start pricing in even the potential for QE number 3, which these pricing in, as I mentioned earlier, could accelerate even further if the U.S. economic data continues to deteriorate. Now, when it comes to the Eurozone economic data, we saw stronger GDP report from the Eurozone. This is going to be on Wednesday at 5 a.m. Eastern Time. This is going to be the second estimate for the Eurozone gross domestic product. And if you recall, the first estimate last month showed us that the Eurozone economy grew by 0.8% quarter over quarter in the first quarter of 2011. That was faster economic growth, almost 3 times as fast as the 0.3% growth in the fourth quarter of 2010. So what we discussed at that time on this program was the fact that when we compare economic growth, for example, just take a look at the GDP reports from the U.S. and from the Eurozone. In the U.S. economy grew by 1.8% in the first quarter, which was slower economic growth than the 3.1% growth that we witnessed in the fourth quarter of 2010. As opposed to the Eurozone GDP, which grew faster in the first quarter of 2011 compared with the fourth quarter of 2010. So obviously there are signs that the U.S. economy in the first quarter slowed down compared with the fourth quarter. Where we didn't see, we saw quite the opposite with the Eurozone economy, doing rather well in the first quarter of 2011 compared with the fourth quarter of 2010. So for this report on Wednesday, more than likely, we're going to see, according to the consensus forecast, we're going to see a confirmation of the preliminary estimate that the Eurozone economy grew by 0.8% quarter over quarter in the first quarter of 2011. So that's what I'm expecting with this report. It could show strength in the Eurozone economy in the first quarter. Obviously, the first quarter is over with, is behind us. GDP reports are normally backward-looking type of economic reports, but it could give, if you will, a little bit of a confidence, if you will, ahead of the European Central Bank interest rate announcement on Thursday that Eurozone growth is really not getting that much worse. And last week, in the last few weeks, we have seen the most recent data showing us some purchasing managers indexes and so forth, beginning to show us some signs of a slowdown in the Eurozone economy. I mean, obviously, the Eurozone economy is not going to be immune from the global economic slowdown, which is happening around the world. But, again, for the most part, the Eurozone economic data has been a little bit, showing a little bit more strength, if you will, compared with the U.S. economic data. And provided, of course, that we don't get to see the market's concerns accelerating again about the outcome of the Eurozone debt crisis, about restructuring of Greek government debt potentially, or even a possible default. Last week, if you recall, Standard & Poor's basically told us that, look, even if you get investors to agree to an extension of the terms of repayment and so forth, to them, to S&P Standard & Poor's, which is one of the credit ratings agencies, they said last Thursday or Friday of last week, they said this is still going to constitute technically a default by Greece. So if investors are not completely convinced that the worst of the crisis is behind us, and we're looking forward to, as we've discussed many times before on this program, that some solutions and new ways to deal with the crisis are going to be announced by the end of this month. June 20th is the Eurogroup meeting of European Union finance ministers, and only 3-4 days later, June 23rd and 24th, is when we're going to see the European Union summit of leaders of the European Union. So these are the two events that we'll be watching later this month for an announcement of what would be the solutions that will be proposed by European Union leaders. But again, if the market concerns are not accelerating next week, at least not until the European Central Bank announcement, and we still see a little stronger Eurozone economic data than other areas, other economies, including the U.S. economy. Then the euro could stay supported, actually, provided, of course, we don't get to see massive risk aversion and investors really getting spooked by some sort of announcement that comes in the next few days throughout next week. I think that the market's been pricing in the expectations for the European Central Bank to hike interest rates another time or two. In 2011, they already did produce an interest rate hike by 25 basis points in April, bringing their interest rates up to 1.25%. And if the market continues to price these expectations, the euro could stay supported. But the euro's trend is definitely going forward, as we discussed weeks ago, is going to actually be driven by risk. And, of course, that's going to be very dependent. Risk appetite, risk aversion, very dependent on what happens with global equities. Is there a slowdown? Is there market sell-off? Weakness in equities? Is there more risk aversion coming in on concerns about the Eurozone debt crisis and so forth? Someone probably joined us a little bit later, and I hope that this webinar is going to be recorded so that they can catch up with that. Their question is to discuss the Aussie versus the US dollar. I think I spent pretty good amount of time discussing this currency pair earlier, so you're welcome to follow up after the program is over with and watch the recording there if you wanted to see some of the analysis that we had earlier on the Aussie dollar currency pair. Now, let's go ahead and take a look at the euro versus the US dollar, and we'll take a look at the daily chart of this currency pair. Here's the daily chart of the euro versus the US dollar. And we discussed that the euro also, just as the Australian dollar I discussed earlier, has gone through a period of a price correction. We talked about that this pullback here from recent highs that were a little bit above, almost at $1.50 at $1.49.39 were the recent highs from, what day was that? That was the 4th of May. After the euro started falling from these highs, we talked that this is not going to be necessarily the trend reversal. It could become an actual trend reversal of that strong bullish positive trend for the euro versus the US dollar, which has taken the euro from as low as $1.2904 or $1.2870 rather on January 10th, all the way up to the recent highs at $1.4939. So that's obviously a very strong multi-month bullish trend and a multi-year bullish trend, because we know for the most part the euro has been on a strong bullish trend since pretty much, 2001 or so, 2002. So obviously strong trends like this are very difficult to reverse, but they do not last indefinitely. And in the meantime, of course, we were preparing for what could be a more significant price correction that we were anticipating that could happen for the euro versus the US dollar. It was that more significant price correction that was triggered by concerns about default by Greece and so forth that had sent the euro from as high as $1.4939 to recent lows a little bit below $1.40 level at $1.3969. Now, the euro quickly after that, however, managed to climb above that major large quarter point, obviously a very important level in my quarters theory, at $1.40 level. It quickly moved back up above $1.40, and it pretty much stayed in its existing 1,000 pip range, which is the 1,000 pip range between $1.40 and $1.50. You can see these lines here. I'm going to move this one. You can see the 1,000 pip range between $1.40 and $1.50. Now, as the euro started bouncing off of these recent lows, the previous resistance that we discussed last weekend on this webinar, I spoke about the resistance shaping up in a $1.43.5 area. Now, one of those lines was put right here, if you recall, last Sunday, and we talked about $43.50. Now, I said that a break above $43.50 could see the euro-dollar pair completing the next large quarter of 250 pips, which would be a quarter between $42.50 and $1.45. That is exactly what we witnessed on Thursday. If you recall, on Thursday, the euro-dollar pair reached as high as $45.13, challenging this resistance here, which was a little bit above the $1.45 level. If you recall, on what was it? April 12th, we had a resistance at the $45.19 and $45.20, two identical highs that served as a level of resistance a little bit above the large quarter point at the $1.45. In my quarters theory, I call these type of moves an overshoot and not really a decisive breakout above a large quarter point at the $1.45. Both of them less than 25 pips above the large quarter point at the $1.45, something that I would classify as an overshoot above that point rather than a decisive breakout. But now, on Friday, as a result of the dismal non-farm payrolls report, which was much, much worse than expected, a lot of major institutions and economists were actually revising their forecasts lower to expect maybe 100,000 compared with 244,000 jobs that the U.S. economy added in the month of April. Well, the May report actually showed the U.S. economy only producing, 58,000 or something like that. That was really terrible non-farm payrolls report, which was much worse than expected. And that's why earlier I was explaining that I wouldn't be surprised to even see a quantitative easing number 3 program that may be considered by the Fed if they have no other choice. So obviously very negative for the U.S. dollar. Further quantitative easing by the Federal Reserve could mean also further debasement of the U.S. currency. So it's not hard to understand, I hope, how the U.S. dollar can come under pressure in that type of an environment. And that was the catalyst for the euro-dollar pair not only to complete the quarter to $1.45 level, but also to break above that resistance at the $1.4520. And it's now reaching as high as, on Friday, reached as high as $1.4642. And so far today, we're reaching as high as $1.4657. So we're well into the next large quarter of 250 pips. And that large quarter, of course, is going to be, somebody forgot to turn their cell phone off. I'm sorry about that. That large quarter, of course, is going to be the quarter between $1.45 and $1.4750 large quarter points. So if you give me a second here, I will draw another line so you can visualize that large quarter a little bit better. Let me grab one of these lines here and put it right here, which should be approximately the $1.4750 area. Now, that would be, of course, the next large quarter point that I'm going to focus on next week and find out, first of all, can the euro muster the strength to continue another 100 pips from where it is right now and complete that large quarter. I wouldn't be surprised if the euro actually manages to do that. We had some previous resistance here that was established at $1.46.5 area. So it's not a surprise to see this area. You can see this line right here. It's not a surprise to see the $1.46.5 area now serving as some area of resistance. But going forward in the days ahead, if the market continues to price in and anticipate that the European Central Bank will maintain its hawkish stance, if you will, and remind the markets of its inflation-fighting role. Inflationary pressures in the Eurozone, many of you would recall, are still elevated at 2.7%, according to the preliminary estimate for the month of June, which is above the 2% comfort level that the European Central Bank prefers to see inflation normally around 2%. If that is the kind of statement we hear from the European Central Bank next week, if the GDP report doesn't offer any disappointments, which I'm not expecting that it will, on Wednesday, as we discussed earlier, 0.8% growth in the first quarter, faster than a 0.3% growth in the fourth quarter of 2010. And obviously, if the euro stays up on if investor sentiment does not sour in the days ahead, because that's possible, obviously. We have seen that happening, and the euro ultimately comes under significant pressure. But if the investor sentiment is positive, at least in the days ahead of the European Central Bank announcement, I think the euro could have a good chance, if it breaks above $46.5 area decisively, to complete at least the large quarter to $47.50. Can the euro go back up to the previous highs at the $49.36? There is a possibility for that, but we're going to have to hear a very, very hawkish type of a statement from the European Central Bank, which I'm not expecting that to be the case, really. I mean, we can see the European Central Bank, in my opinion, reminding the markets that they will remain, as they called it previously, vigilant. But they more than likely are going to sit on the sidelines, not hike interest rates here in June. And I think that would be the prudent thing to do, actually, now that the market's kind of focused on what would be the solutions to the debt crisis, to dealing with the Greek problems and so forth. The due date for these solutions to be announced is coming, as we discussed earlier, at the end of June, June 20th, June 23rd, 24th are the Eurogroup meetings, then the European Union Summit as well of European leaders. Ahead of these important meetings, the European Central Bank could possibly decide to sit on the sidelines, although before they have said that it doesn't matter what the situation with the debt crisis is. Their main mandate is to ensure price stability, to quote their exact words. That's a reminder of their inflation-fighting role. And they have been very, very vigilant, and they can say we're going to stay vigilant, but I think that the euro could see some unwinding of long positions, possibly following the European Central Bank announcement, provided, of course, it doesn't happen earlier if we get to see investors' concerns increasing significantly in the days ahead, leading to the European Central Bank announcement. But the euro has managed to break above these highs, and the door is open now. If the $64.50 or 46.50 area, is broken decisively above, the door could be open to at least the euro-dollar pair complete the quarter to $0.750, $47.50, and then, of course, after that, we'll have to monitor very closely the price behavior of the euro-dollar pair to see whether it shows some strength to continue even further and to maybe challenge $49.39, the recent highs. Now, of course, if the Fed announces some sort of a quantitative easing number 3 program, the euro could very well not only reach these previous highs, but it could actually move well above into the $1.50, the $1.50s, above $1.50. But until that happens, I think that the euro may be due for a little bit of a price correction here after significant strengthening for how many days? 1, 2, 3, 4, 5, 6, 7, 8, 9, to be 10 days potentially, as we're starting the new trading session just now. Of course, the opposite scenario, the bearish scenario for the euro would be the euro finding some significant resistance either at the $46.5 or anywhere between $46.5 and $47.5, which is the large quarter point there. Important level in my forest theory, obviously. If the euro finds significant resistance within that 100 pip range, we could see it at least coming down a little bit to $1.45 perhaps, which would be the previous resistance that could now turn as a level of support on a price correction of these strengthening of the euro in the recent week or so versus the US dollar. Well, let's go ahead and move to the next major spotlight event for us next week, which is going to come from New Zealand with the Reserve Bank of New Zealand interest rate announcement. Many of you who pay attention to news events and pay close attention to the New Zealand dollar, especially its rally versus the US dollar to new record highs, which, surprise, surprise, were close to a large quarter point there at 0.8250 for the Kiwi US dollar exchange rate. You may have remember that in the first quarter of 2011, after the February earthquake in Christchurch in New Zealand, which was a devastating earthquake, it had a negative impact on the New Zealand economic activity. We had the Reserve Bank of New Zealand stepping in the month after that and producing a very aggressive interest rate cut by 50 basis points. The Reserve Bank of New Zealand pretty much undid the two interest rate hikes that they produced in 2010. They felt that they had to do it. It was an emergency response by the Reserve Bank of New Zealand. But in recent weeks, because of strengthening in New Zealand economic data, and by the way, speaking about strengthening in New Zealand economic data, exports in New Zealand recent reports showed that they climbed to a record high in April. Other data also showed some resilience in the New Zealand economy, and we started to see, obviously, commodity prices rallying, strengthening, causing inflationary pressures, and so forth. That is why in recent weeks we have seen increased speculation, in my opinion, that the Reserve Bank of New Zealand may need to undo the aggressive 50 basis points interest rate cut that was made in an effort to assist in the recovery efforts after the earthquake. So if that is what the market continues to price in, and if there is any hint with the Reserve Bank of New Zealand's interest rate announcement on Wednesday night at 5 p.m. Eastern Time, if there is any hint that the Reserve Bank of New Zealand has a positive outlook on the economy, feels that the economy is going to continue to strengthen going forward, and also feels that inflationary pressures are going to continue to increase, those could be the two factors that could cause them to start hiking interest rates again and undo the 50 basis points interest rate cut that was made in February, and bring back the interest rates higher, the benchmark interest rate higher in New Zealand. If that's the kind of statement we witness next Wednesday, the New Zealand dollar could really stay supported because the weakness in the Australian dollar that we discussed recently. The New Zealand dollar, in my opinion, has become the preferred choice for traders and investors who are looking for higher yields because of the potential for the Reserve Bank of New Zealand to possibly start hiking rates again in the months ahead. The New Zealand dollar could stay supported, although as we are going to take a look now at the daily chart of the Kiwi dollar pair, you're going to see that that currency pair may be due for some price correction, which already started a little bit last week. Here's the daily chart of the Kiwi against the US dollar. Now, in previous webinars, we have discussed that breakout above the previous all-time high, which was 0.8120. The New Zealand dollar broke above that level. And what did I say last Sunday could happen? What could be the next logical price point that we can anticipate the Kiwi dollar pair to challenge? Well, those of you who listened to the webinar last Sunday will remember that I discussed 0.8250 being an important level in my quarter here, being the large quarter point there, that could be the next price level to challenge. Ladies and gentlemen, this is very important here, and I want to make a very important point and give you a great example as to how my quarters theory could be a very helpful tool for any trader. Why? Because anyone who pays attention to the New Zealand dollar versus the US dollar knows that anything above 0.8120, which was the previously established all-time high for the Kiwi against the dollar, or at least a record high since the New Zealand dollar was allowed to float freely in the open markets by the New Zealand government in 1983 or 84 or 85, one of those 3 years. I don't know exactly which one it was right now at the top of my head. Anything above 0.8120, the previous record high, was uncharted territory, unfamiliar territory for any trader out there who relies solely on support resistance levels. You simply have no historic price points of reference anywhere at any price level above 0.8120. So here's how my quarters theory could be helpful as far as knowing the premise of the quarters theory, which is I propose that currency exchange rate fluctuations are not random, but they occur from one large quarter point targeting the next large quarter point. Now, with a decisive breakout above 0.8120, what would be the next large quarter point level that could be challenged? I explained that last Sunday. That would be the large quarter point at 0.8250. So the large quarter point here's a great example as to how the large quarter point at 0.8250 and my quarters theory in general could have been a very helpful tool for any trader out there who was trying to set up some realistic price targets and expectations as far as what a breakout could produce if the New Zealand dollar versus the US dollar currency pair were to break above the previous record high at 0.8120. It could produce a move to 0.8250, which it actually did. Recent highs were at 0.8262, and that's a 12/5 of an overshoot above the large quarter point at 0.8250. It so it happens that right around that area at 0.8250, the New Zealand dollar has also begun to see some price correction and profit taking kicking in as well, which was long due because the Kiwi pretty much rallied for, 7 consecutive trading sessions to break above the record high and produce a new record high at 0.8262, only 12/5 above the large quarter point at 0.8250. In recent days, last week, the Kiwi has fallen from these record highs and is going through a welcome price correction. But don't be fooled by price corrections thinking that they're going to be the trend reversals, because more than likely, with such a strong trend, multi-month strong bullish trend for the Kiwi against the US dollar, if investor sentiment is positive next week, don't be surprised to see the trend continuing, and do not be surprised when you have such strong trends on any pullbacks to witness more traders coming in to reposition themselves at lower price levels in anticipation for these previously established strong trends to continue further. Now, the previous record high at 0.8120 naturally could have served as a level of support, but that has not been the case, however. And on Friday, we saw the Kiwi actually dropping to a low of 0.8071, which is about 50 pips below that previous resistance that could have turned itself as a strong level of support. It's not really that strong of a level of support, so be cautious about that. And the New Zealand dollar now lingers with an intraday high at 0.8166. It's a little bit above 0.8120 again. But if we start breaking below that 0.8120 area once again, and then we see the Kiwi break below 0.8071, don't be surprised to see the 0.80 cents large quarter point serving as the next level of support, which of course is the major large quarter point there at 0.80 cents. And it used to be a resistance here, you would recall that as well. For obvious reasons, it was a resistance. It's a major, major junction. As I explained in my quarters theory, these major call numbers are very important major junctions that signify the end of a 1,000 pip range and at the same time the beginning of a new 1,000 pip range. And a 0.80 cents level signifies the end of the 0.70s 1,000 pip range between 0.70 and 0.80 cents, and at the same time the beginning of the new 1,000 pip range between 0.80 and 0.90 cents for the Kiwi dollar exchange rate. So it's not a surprise if these previous support levels are broken for us to see the move to 0.80 cents, but if the Kiwi finds a base, even if it falls to 0.80, if it finds a base around 0.80 cents, I bet you there's going to be a lot more traders interested in considering re-entry positions at lower price levels when such trends are still strong and if they, of course, stay intact. Now let's go ahead and take a look at the next major spotlight event. which is going to come from Japan with the gross domestic product report, the main measure of economic activity and growth. By the way, this event may be an actual non-event, simply because it's the second estimate, it's the final revision of the previous estimate, which showed us officially that the Japanese economy entered its, third recession. Its third recession in a decade. Having 3 recessions in a decade, the Japanese economy. It contracted for 2 consecutive quarters in the fourth quarter of 2010 and also in the first quarter of 2011. In the first quarter of 2011 GDP report is the one we're going to see on Wednesday at 7:50 p.m. Eastern Time. More than likely that report is going to show us the same thing the preliminary estimate showed us, that the Japanese economy contracted in the first quarter, but it might be revised a little bit to show a little bit of a lesser contraction. The preliminary estimate showed the Japanese economy contracting by 0.9% quarter over quarter in the first quarter of 2011. The revised estimate is forecast to show the economy shrinking a bit less by 0.8% quarter over quarter in the first quarter of 2011. That would be exactly the same amount of a contraction, 0.8%, that the Japanese economy contracted in the fourth quarter of 2010. So 2 consecutive quarters of contraction, that is the definition of recession. And the Japanese economy entered its third one in the last decade. However, the Japanese yen is one of the main beneficiaries of the risk-averse market environment. So it's not a surprise, despite of the contraction in the Japanese economy in the fourth and the first quarter of 2004, quarter of 2010, first of 2011, not a surprise to see the Japanese economy on the risk, the Japanese yen rather, on the risk aversion actually beginning to strengthen. And that strengthening is causing the dollar-yen currency pair to produce the bearish trend development scenario that we discussed last Sunday. Let me refresh your memories. Last Sunday, I drew these lines to show you what could be a possible range that we could witness the dollar-yen currency pair trading within. Especially, as I explained last Sunday, if the dollar-yen for another attempt or two fails to break above the top of the existing range, which was the 82.23 level, which is only 27 pips below the large quarter point, by the way, at 82.50. This is why I explained last Sunday that for the most part, in the last month or so, throughout the month of May pretty much, the dollar-yen currency pair has been trading for the most part within the range between the large quarter range of 250 pips between 80 yen and a large quarter point at 82.50 yen. We had a little bit of a dip below 80 yen to a low of 79.56 yen, after which the dollar-yen currency pair moved above 80 yen level again, and it moved to the large quarter point area of 82.50 yen. Did not break above resistance, the top of the range at 82.23, and then as a result of that, and also as a result of weak economic data in the U.S., risk aversion as well, the Japanese yen started pushing the U.S. dollar lower back to, guess where? The major large quarter point at 80 yen. So should we consider the drop to the low on Friday at 80.04 as a complete coincidence? I don't think so. This was the move back to the major large quarter point at 80 yen. So next week we'll watch the 80 yen level, because if 80 yen is broken below, then we can target the ultimate bottom of the range, which is the support at 79.56. And also on top of that, any moves below 80 yen could also increase the market speculation and expectations that the Bank of Japan, along with other major central banks, could be forced into doing one of those so-called multilateral interventions, where the major central banks come together in order to intervene and curb the strength of the Japanese yen, just as it happened most recently on May 17th. You might recall the intervention, and then obviously you can see the dollar jumping off of these record post-World War II low at 76.34 yen. So the dollar-yen is confined within this range. We'll watch the bottom of the range for a possible breakout. If a breakout occurs, the dollar could move lower below 0.80 yen, below 80 yen level. But along with that, any significant and rapid decline below 80 yen could be met with another possible intervention, especially if the dollar approaches these previous record lows. Now, we have to wrap things up in the next 5 minutes, so I'm going to go very quickly. I know we had a late start, and go over quickly the rest of the 5 important spotlight events for the rest of the week. I already mentioned a little bit about the Australian employment situation being another spotlight event from Australia. And the Australian employment report's coming up on Wednesday night, and it is expected, actually, the Australian economy to recover from that massive loss. It was very unexpected. The Australian economy lost 22,100 jobs in April, but we're expecting for the loss to be recovered by the Australian economy creating up to 25,000 new jobs. This is why I think that we could have a positive employment report which could be supportive for the Australian dollar on Wednesday. And if that is coupled with a hawkish statement from the Reserve Bank of Australia early on Tuesday morning, that is why I said the Australian dollar could find potentially catalysts for possible strengthening, at least in the first several days of next week, provided, of course, we don't get to see massive risk aversion on dead fears about the crisis in the Eurozone or any other concerns. Obviously, 2 main events next week will be the Bank of England interest rate announcement. No changes are expected there. More than likely, the Bank of England will stay on the sidelines. Probably in June or July, some experts are saying the first rate hike will come as early as August. So we may have another couple of months where the Bank of England sits on the sidelines. And as long as that's the case, and as long as we don't get to see some sort of massive risk aversion, the pound-dollar exchange rate could really stay into the $60s, 1,000 pip range, where it has been lingering for a number of months now. Next event, and that's the main event, by the way, for next week, in my opinion, will bring us the European Central Bank interest rate announcement. And as I said, the European Central Bank might hike interest rates going forward another time or two in 2011, but I'm not expecting them to do that next Thursday. And if that is coupled with a less hawkish statement, the euro could possibly see some unwinding of long positions and a welcome price correction, as I explained earlier when we looked at the euro-dollar exchange rate. Another spotlight event on Thursday is going to bring us the jobless claims from the U.S. Lackluster performance in the U.S. Jobs market more than likely will continue another week potentially, according to the forecast, when the unemployment benefits are forecast to reach a number above 400,000, 419,000. For a number of months on this webinar, I've been talking about 375,000 level, which is the magic number. Economists are forecasting that jobless applications would need to fall below 375,000 in order for us to see significant improvement in the U.S. jobs market and decline in the unemployment rate. Obviously, that is not expected to happen with the report next week. So it could be another weak jobs report from the U.S. On Friday also we have the UK industrial production, which is expected to increase, by the way, by 1.3% month over month in April from 0.7% in March. Could be a positive report from the UK, which could keep the British pound supported on Friday. And then also on Friday, I wanted to talk about this event a little bit more because we haven't really had a chance to look at the pound or the Canadian dollar. Those are going to be a couple of major currencies toward the end of next week that we're going to watch, obviously because the Bank of England announcement on Thursday, but also because the employment report from Canada on Friday, that's their equivalent to the non-farm payrolls report in the U.S. And we can see the Canadian economy adding jobs next in May, 23,400 new jobs in May, compared with, which will be a lower jobs creation compared with 58,300 jobs created in April. For the most part, the dollar-Canadian dollar currency pair has been trading in a range, and that could continue to be the case, provided there's no some sort of surprises next week. Well, that's about enough time for us to cover all the events, and I wanted to invite you very quickly as well to listen to the All Things Forex daily broadcast at allthingsforex.com, Monday through Friday, 8 to 9 a.m. Eastern Time. Thank you all very much for attending the webinar today. Thanks to our friends at fx3.com. Have a great week, and let me remind you that today's program is not intended to be considered as giving any buy, sell, or hold recommendations. It is intended for educational and informational purposes only. Thank you very much for listening. I'm looking forward to seeing you again next Sunday at 6 p.m. Eastern Time.